Hi, we're going to start a unit on credit and managing credit, and there's quite a few chapters, but we're going to start on chapter 7, which is credit in America, and we're going to start with the credit, the what and the why. And the first thing that I want to talk about is just defining what credit is. So credit's using someone else's money and promising to pay it back later. So we actually get money that belongs to someone else, and then we pay it back, typically with some sort of fee. So as we continue to discuss the what of credit, we need to understand a lot of different terms. So all these terms I'm going to go ahead and put up here on the screen, but just know that the debtor is the person who's borrowing, the creditor is the one who's lending the money. So debtor borrows, creditor lends. And when they lend, they tend to charge fees, such as interest related to that. And the debtor, the one borrowing, has to qualify to receive credit. So we're going to talk about what it takes to qualify for credit, and then talk about the part where we actually have to pay it back. So in order to qualify for credit, you have to have the ability to repay the loan. And there's three things here that show or that you consider when trying to determine whether or not someone does qualify. Income is a recurring thing. I would know that. So we'll do a slide on it, but it's salary typically. The financial position's looking at right now what the situation is from what you own, and then the collateral's really looking to the future to see what kinds of assets you can pledge. So let's look at it in a little more detail. So the first qualification criteria is income, and this lists lots of different sources of income, and then each of these is going to give you a rule of thumb. The rule of thumb on income is when your earnings exceed your expenses, you have the capacity to take on debt. So you can take on debt. It doesn't necessarily mean you should, but you can. The next one is your financial position. And financial position, capital is really crucial. And capital is the value of all the property that you possess after deducting all your debts. So all the property I have, checking accounts, savings accounts, investments, real estate, other assets, and then I subtract whatever debt I already have, and that is what my capital is. The rule of thumb here is having capital means that you have accumulated assets, which indicates to a lender that you're responsible. So you're accumulating more assets than you are debt, and that shows that you're financially responsible. And then the final qualification for debt is collateral. And typically, if you're going to borrow money, the lender wants you to put up collateral oftentimes. And collateral is this property that you pledge to assure payment. So this rule of thumb again on this third bullet is if you don't make your loan payments to that creditor, they're going to repossess those assets, that property, sell your property in order to repay the loan. So if you don't pay the loan back, they'll take what you got to pay it back. So that's the three qualifications for credit. We had income, we had financial position, and we had collateral. And then the last part of the what on credit is making payments. So once I've made a purchase on credit, I owe money to the creditor. And the question is, how much do I owe? So the balance due is the amount that I owe the creditor, and that's the amount I borrowed, which is the principal, and then interest for the entire time of the loan. This interest is computed just like we talked about in chapter 6, with interest equal to principal times rate times time. So you'll utilize those skills in chapter 7 as well. And the finance charge is the total dollar amount of all the interest and fees you pay for the use of credit. So you're for sure paying interest, but you may start to pay late fees and other things. That all adds up to what the finance charge is. So that's the what part of credit. So now we're going to talk about the why part. So let's talk about the advantages and disadvantages of credit. This is on page 160 and 161 of your textbook. If you want to look at that in more detail, your homework is also going to be to do page 69 of your workbook, which starts with these advantages and disadvantages. So you might want to just take notes straight on that workbook page. So first I'm going to put up the advantages of credit. So the first one is purchasing power. If I had just cash, the amount of things I could purchase is less than if I have credit. So I get more purchasing power because I don't have to have cash right now. I can use some of my credit and get more. So it increases your purchasing power. Security is better with credit. It's easy to steal cash. It's harder to steal your credit card information or other credit information and utilize that. I'm not saying it can't be done, but it is more difficult. It helps you establish good credit, so it will help you qualify for loans, and hopefully when qualifying for those loans you can also qualify for lower interest rates. The fourth one is emergencies. So the way that credit typically helps you on that is if you establish a line of credit which says at the bank that they will lend you up to X amount anytime you want, and you can tap into that line of credit whenever you have needs, knowing that you will have to pay it back as well. And then there's other benefits and leverage that I'm not going to go into detail about. So then let's talk about the disadvantages. So the biggest disadvantage, hands down, is fees and finance charges. So they will tend to fee you to death just like all banks do. So you'll pay interest charges, you'll pay late fees, you'll pay early withdrawal penalties, you'll pay all these different fees and finance charges, and they add up. So that's one disadvantage. If I paid with cash, I wouldn't have any of those fees. It's a reduction of future buying power, because as I use credit, that means that I have now committed future earnings to paying that back, which means that those earnings in the future aren't available to buy things down the road. So it reduces buying power. And then overspending, that is a huge problem for a lot of people. So they spend way too much, overextend themselves on the credit and have a difficult time paying it back. And then identity theft. If I use cash, no one can steal my identity based on getting that cash. But if they get my credit card and get other information, it's easy for them to do that. So those are the advantages and disadvantages and the why of why we would use credit, and we talked about the what. So that wraps up section 7.1.